Joining us right now to break it all down, tell you what to expect and what the market reaction may be is Sam Stovall. He is CFRA's Research Chief Investment Strategist. And Sam, this jobs report has gotten ever more important over the last many weeks. We're waiting on seeing what happens there, and we know the Fed's waiting too. So how are you feeling as we get back into this whole season of September? Everybody's back to work. Traders are back too. It's been a little choppy so far.
Oh, sure, it has been, Becky. I think investors have surrendered to seasonality in the first two trading days of the month, and I think there's going to be a lot more volatility until the end of October, which historically has been the case. All sizes, styles, and sectors within the S&P have posted average declines going back to 1992. But I think in terms of employment data, we probably will end up being favorably surprised with today's ADP report, with the jobless claims, and also with the payroll numbers on Friday. I think we'll find that a lot of the weakness in July was weather related.
So if we're going to be favorably surprised by these things, the next question for investors is, how does the Fed react to that? You think that would set them up for a 25 basis point cut?
I think that it will be setting them up for a 25 basis point cut. That's our expectation for a total of 3 cuts of 25 basis points each for this year, and then 4 more cuts next year. Our feeling is that, if you look back to Fed rate history, that only twice has the Fed cut initially by 50 basis points, and that was in 2001 and 2007. So I think investors will probably end up feeling that the Fed knows something we don't if they cut by 50 basis points this time as well.
Okay, that's what we've heard back and forth. But we also heard people that we spoke with yesterday who said, look, if they don't cut by 50 basis points, we're going to be in very big trouble because the economy is worse than expected. You don't believe what we saw in July, some of those early readings that we got in July and last month. You think that this is really a much stronger economy than some of those negative naysayers are thinking?
Yes, we do. We actually raised our GDP forecast for this year and next. Was 2.7 for this year, now 2.8. Was 2.1 for 2025, now 2.2. Our feeling is that while the economy will be slowing next year relative to this year, that we will still be on course for a soft landing. Plus, I think the market really has not been moving in the direction that investors really would like. And so, once again, investors are acting like hyperactive first graders playing musical chairs, always trying to out-anticipate the other.
Okay, you've said from a technical perspective that when you get to this overbought conditions, you're looking at the market as being overbought. That's what's causing these sell-offs. So you think the economy's strong, but maybe you think the markets are highly priced, I should say?
Well, I think that there is some benefit to digesting some of the recent gains. We're still looking at technology trading at a 50% premium to its average 20-year PE on forward estimates, but that's certainly down from a 78% premium that we saw just recently. The S&P 500 at a 30% premium, down from 38. So I think that we are getting there, and plus, when you do have an overbought situation, doesn't mean the world's coming to an end. It simply means that the dials are going to be reset. So we're still firmly in the bull market camp, but just feel that the market has gone a bit ahead of itself.
That's okay. If I'm sitting at home and I'm listening to this, I think, okay, so that explains the huge, vomit that came out of the market on Tuesday when you were looking at any of the semiconductors or anything across the board, that it doesn't have anything to do with the potential for a subpoena that did or did not come to NVIDIA. NVIDIA is saying they didn't get a subpoena. This is just investor sentiment turning on a dime because we realize, oh my gosh, we've really bid things up.
Well, certainly when we look at the semiconductor group, and this is a group that was up by 3 digits, 100+% over the past 12 months, et cetera, trading at a PE multiple that's about 80 times or an 80% premium to its long-term average. Yes, you can look to individual groups of the overall marketplace and see where there has been excess. But at the same time, while the semiconductors have been readjusting, we have been seeing a broadening out of the overall marketplace. So seeing those groups within the 1500 that are above their 50-day, above their 200-day, and above both of those indicators, we're seeing actually an increase along the way. So I would regard that more as a positive spreading of expectations rather than being shaken by simply one group going through a digestion.
Sam, do you think we're in for a big drop in the markets in September or October or not?
Well, there's certainly a possibility. Since World War II, we have had 30 times that we have had two intra-year declines of 5% or more. And in 9 of those 30 times, we had 3 or more. So if we do end up falling into a decline in excess of 5%, history says it'll probably be in the low double-digit area, 12.5% being the average. And certainly that could shake investors' mindset. But typically, you get back to break even in an average of only 4 months from declines of up to 20%.